Hello, everybody. My name is Michael Duke, and this is the channel where I analyze stocks that are interesting. So, if you find that interesting, please consider liking this video and subscribing to the channel. Today, we're going to be talking about LKQ Corporation, ticker LKQ. As always, this is not a recommendation to buy or sell a particular security. Always do your own analysis. As always, I'm going to give an overview of the company the best that I can. We're going to take a look at the investment thesis, why it may or may not be a compelling investment, a compelling stock. Uh, we're going to take a look at the financial performance, the valuation, discuss some of the risk factors, and then do a technical analysis before I give it a grade: buy, sell, or hold. All right, let's get on into it. So first off, just want to point out this company has a limited history in public markets. Well, actually not. I'm confusing this with something else I was looking at earlier today. Rather, over the last few years, the stock price performance has been very underwhelming. I've been watching this company for several years now. It's always looked very expensive. And uh, taking a look at it now because it's done very poorly the last few years, down 50% in the last five, down 42% in the last year. So, on a forward looking basis, we're less than a 10 multiple on earnings. So, naturally, it has my attention. So, let's just kind of jump into what the company does. LKQ Corporation engages in the distribution of replacement parts, components, and systems used in the repair and maintenance of vehicles and specialty vehicle aftermarket products and accessories. The company operates through four segments: wholesale North America, Europe, specialty, and self-service. It offers bumper covers, automotive body panels, and lights, as well as paint and paint-related consumables for refinishing vehicles, mechanical automotive parts and accessories, salvage products, including mechanical and collision parts comprising engines, transmissions, door assemblies, sheet metal products such as trunk lids, fenders, and hoods, and lights and bumper assemblies. The company also provides scrap metal and other materials to metals recyclers, precious metals, such as catalytic converters and brake pads, discs and sensors, clutches, steering and suspension products, filters, oil, automotive fluids. This is so much. As well as electrical products, including spark plugs and batteries. In addition, does business all over the world, operates in the United States, Canada, Germany, UK, Belgium, the Netherlands, Luxembourg, Italy, Czech Republic, other European countries. So that's a lot to unpack. I think maybe we can get a better idea if we take a look at their website. Back in 1998, the world saw a fragmented salvage and recycled auto parts industry. Our founders, however, saw an opportunity to provide quality, high-value alternatives for the automotive replacement parts marketplace. Since then, we have continued driving forward. The commitment to continuous improvement. LKQ Corporation is the leading provider of alternative aftermarket specialty salvage and recycled auto parts and services to repair and accessorize vehicles. We offer our customers a broad range of replacement discount auto parts, including remanufactured engines and transmissions, originally formed in 1998 through the combination of a number of wholesale recycled products businesses located in Florida, Michigan, Ohio, and Wisconsin. Let's take a look at investor relations. Let's pull up one of their reports. Let's look at this. April 30th. Okay, let's take a look at the earnings. What I'm going to do, just see if we could get a little bit more context on the actual operation. We're going to come back to this as we analyze the financial performance. So let's just move into the thesis for a second. So what this company owns, we'll get an idea if we look at the balance sheet. This company owns is salvage yards. So they provide the parts, but they're salvaging the parts off of reclaimed vehicles. Okay. And so there's an element of scale to that, with the amount of property and inventory that they have. We see here on a gross basis, $4.1 billion gross property, plant, and equipment. So does this company have a moat? Well, I will say I don't know a ton about this industry, but based on what I do know and what I've been learning is arguably they do, just due to the salvage yard operation. That is the network effect. Just because you're talking about a significant level of volume of vehicles processed, and the acquisition cost of that inventory is low or even negative depending on how those economics work. So that's super interesting, and that gives them a level of scale that's really hard to replicate because that type of business is pretty capital intensive. But I think it's worth um, discussing that the investment thesis here is more financially driven, where the valuation is impressively cheap. There's some pretty deep value here, trading for less than half time sales. They're trading for less than one time book. All of these valuation metrics significantly lower than the 5-year average. So we're talking about a business that's just has some durable recession resistant qualities. Although vehicles are more of a discretionary item, they sit at the level of the value chain that I think is a little bit more durable than the discretionary aspects of it. You see here they're in the discretionary sector on Seeking Alpha. But the valuation to me implies a deep level of value, and on a yield basis they're approaching 5%. So pure cash yield terms, we've got a risk premium over the 10-year treasury. Not on earnings yield, on dividend yield. So I think really the main thesis here is that this is a company that for a while was, priced as a compounder, had really good share performance, priced as a compounder. It's fallen from grace. And, that payout appears to be safe. We're talking about, $3 a share of earnings versus $1.20 of dividend. So the valuation is that it's a company that's been priced at a premium that no longer is. And furthermore, it's not just a fair valuation. Valuation is incredibly attractive, I think, in a lot of ways. So in terms of the underlying financial performance, and this is where we can kind of go back to this part here. Let's take a look at the quarterly numbers. Again, this is as of April 30th, so just a few weeks ago. Total revenue up 4.3%. Organic parts and services revenue growth, there was a decline there. EBITDA down, EBITDA margin down, earnings per share down significantly on a diluted basis. Adjusted diluted EPS down quite a bit. They did have negative free cash flow. Okay. So that makes the, safety of the dividend look a little bit less appealing, I suppose. Let's kind of drill into some of these other numbers here. Revenue year over year, Europe looking particularly challenged in parts and service, decline in EBITDA, negative free cash flow. So you see why the stock has so meaningfully underperformed. I mean, these results just don't look good, right? So we had an increase in revenue, but our gross profit declined. So 200 basis points of gross margin erosion. SG&A went down. So EBITDA fared a little bit better, 1.7 contraction, 1.7% of contraction in EBITDA margin. Let's move my face into a different place. Looking at Europe, revenue was up, margins declined somewhat, but we still had higher gross profit. SG&A up quite a bit. So EBITDA margin erosion. Specialty, revenue big up, gross margin up with better margins, SG&A up quite a bit. So segment EBITDA down again. Let's take a look at this. $40 million of CapEx, $77 million of dividends. $335 million of cash, $3.9 billion of debt, $2 billion of liquidity. Now, here's what's interesting right here. Share repurchase program capacity remaining, 1.5 billion of share repurchases authorized. Now, that's more than the amount of cash that they have. So this liquidity would, presumably come from some sort of credit line that they have, revolving facility. But again, if we just take a look at the share repurchase program for a second, back it up to their market cap. The market cap right now, 6.32 billion. Okay. So 1.5 billion is almost 25% of the entire market cap that they have authorized to repurchase. Of course, when you're not spitting off serious cash, as they've struggled to do in the most recent quarter, there were no repurchases. You see 77 million of dividends. They didn't buy back any shares. You see that there's some debt maturities. However, it's investment grade credit rating. So there's nothing about this that looks, unmanageable to me. So I find that share repurchase program particularly interesting. It's definitely something that could unlock a lot of value if they decide to pursue, even partially, to extinguish a significant amount of the market cap at these depressed prices. So that's definitely something to monitor and a potential catalyst. Now their outlook here, guiding to 290 to 320. That's what we saw in the Seeking Alpha forward earnings. Still guiding to that. Guiding to 9 to 1100 million of operating cash flow. 700 to 850 million of free cash flow. They're saying that's they're guiding to that. Okay. So again, that's enough free cash flow. Again, they're only paying, this would be about 300 million of dividends annually. They haven't raised the dividend in a little bit. 308 million on an annual run rate. So if they did achieve this free cash flow number here and applied what was there to the share repurchase program, that would be almost 10% of today's market cap, 7 or 8%, 10% rounding up. So that's a pretty significant potential lever of upside, should they choose to pull it. Okay. Now, what's interesting here is we had a really soft quarter. We had negative free cash flow. I don't know if that's just a component of what the first quarter normally is to them. That certainly didn't, kind of a mixed bag there. However, I find that share repurchase program to be pretty significant. And again, if we take their guidance at face value there, which we shouldn't, but if we do, then that's a significant catalyst for driving earnings growth in a pure financial engineering sense. So let's drill back into these numbers here. I want to zoom out on the revenue picture. So over 10 years, 8.5 billion, December 2016, 8.5 billion of revenue. It's almost 14 billion over the trailing 12. That's pretty meaningful. That's 60% growth over 10 years. That's double digits, I believe. 3.3 billion of gross profit to 5.3 billion. So gross profit margin, 3.3 over 8.5. Again, these are rough numbers, 39%, 38%. Again, I'm not using the exact numbers there. Gross profit's been relatively stable all throughout that. Operating income, however, has been challenged we see that operating income peaked December 2021. Now, one thing to consider here, depreciation and amortization is getting netted out of that. That's a non-cash expense. However, if you take that out, you're still left right here with 175 versus 1.4. So operating margins have been pressured versus the gross profit. Revenue versus gross profit looks healthy. The operating income, however, tells a slightly different story. So that's not awesome. And then we see that similar trend in earnings from continued operations. That also kind of filters from operating income. So gross profit, of course, is really the true profit of your actual, business economics, and then everything after that is kind of the administrative structure underneath it. It's kind of a mixed bag here of results. However, we do see they have been aggressively buying back shares the whole time. 310 million of shares. There was some, dilution happening. But really, since December 2020, 305 million of shares, 257 million of shares. Okay, so that's like 17, 18% of the entire float extinguished over that time frame. So I find that particularly interesting, right? I find that very interesting. Take a look at their balance sheet. Really no noticeable trend there. Nothing to really decipher one way or the other. Just kind of a steady balance hovering around 300 million the whole time. Most of their current assets tied up in inventory and AR. A little bit of cash too. Again, we know they got significant property holdings. Lots of goodwill, which tells me that they've done a lot of mergers and acquisitions. It's going to inflate the book value. So perhaps that makes our book value metric not look quite as attractive. Total liabilities of 865 billion. What are our current liabilities? 3.5 billion. 2 billion of payables, long-term debt coming into current status. It's not the best balance sheet I've seen, but it's certainly healthy to see on a retained earnings basis. They haven't been dipping into the coffers to buy back those shares and to pay those dividends. They've continued to retain earnings. So all of those things in totality, they don't tell me that the company's over leveraged, at least historically, and that it is cash generative. Book value per share perhaps needs to be qualified a little bit due to the goodwill. I mean, if you strip that out entirely, I mean, that's a significant amount of goodwill. So they don't keep a ton of cash on hand, certainly not the worst I've seen. But I think the goodwill is the only thing about their balance sheet that I don't love, although that's just a side effect of doing acquisitions, which I like doing acquisitions. So there's that. All in all, balance sheet looks healthy. Lots of positives to take away from that. It doesn't blow me away. Nothing about their income statement blows me away either. However, when I look at the revenue and gross profit, I see a business that on the surface is healthy and that might have some ability to restructure themselves, reorganize, potentially unlock shareholder value. And let's see if we can just see in the news here if there's anything that might give us some insight into that. So here, earnings call insights from Seeking Alpha. We've engaged both Bank of America Securities and Goldman Sachs to identify and evaluate a range of alternatives with the objective of maximizing long-term shareholder value. Last quarter, I noted the specialty process was robust. That remains true. We haven't shut down the process. We still believe it is too soon to reflect a meaningful market recovery in our outlook. Continue to expect to realize more than 50 million in annual cost savings. Okay, let's see if we can just find. Okay, right here. Is there thought of buyback? CFO Galloway says we didn't purchase any shares in Q1, but you would expect to see share repurchases throughout the rest of the year. Again, that could be a catalyst, both in helping create a price floor on the shares with a big bid, backstopping it, but also to drive earnings growth on paper. So it appears that they're discussing selling the specialty segment here. Not a whole lot to unpack there. Maybe we look here. This is from the February earnings. Jude also announced the formal initiation of a comprehensive strategic review. Board and I, along with our entire management team, are aligned in our confidence that LKQ's future, and that confidence compels us to explore whether alternative structures could unlock value more effectively than the market is recognizing today. Okay, here we go. So he outlined significant portfolio simplification, including the divestiture of the self-service segment and progress in SKU rationalization in Europe, even though the specialty segment had good performance. That's interesting. Well, maybe we should go back and look at this specialty segment. Specialty, 3.5 billion of revenue. Specialty was 400 of that, so 12%. However, you do see here the EBITDA margins, gross and EBITDA margins of the specialty segment significantly lower than the rest of the portfolio. So that's why they're thinking of selling it. And that's interesting because if they sell it, get a good price, they'll be able to extinguish debt, they'll be able to buy back shares, and their margins will go up, making their business look better on paper. I think that also kind of gives you an idea of what the difference in the moat or lack thereof is in these different business lines. The higher the gross margin, usually, the more sticky and price making that service line is. So overall, I think again, price book. I think maybe we need to kind of back up a little bit on our bullishness there, because we see here tangible book value per share is basically zero, more or less. So the majority of that book value per share is coming from okay, yeah, right here, goodwill and other intangibles, right there. 6.4 billion goodwill and other intangibles versus the $6.3 billion market cap. Yeah, so I changed my mind. Changed my mind on the price book thing. All the other metrics look very good. It still is, on a multiple of what it's generating, looking very attractive. However, that price book, we really shouldn't take any sort of stock in the price book ratio, given the intangible assets. It's not like they're not worth anything, but I certainly am not a good compass of what intangible assets would be worth, particularly in this business. Let's just do a technical analysis here before we conclude. This one's kind of been a mixed bag. Just kind of keep it to the current environment that we're living in here. Let's just move this up a little bit. Again, rough charts. We're in a clear downtrend here. Can't zoom out anymore. There we go. Clear downtrend. There have been a few times where we've gapped down, presumably on earnings. Certainly not a good looking chart. Furthermore, it does appear here, that taking the chart at face value, that, we kind of broke through the floor. There was a floor right here that we were bouncing off of. We consolidated there. We consolidated here, right? Consolidating right here. We broke all the way through that. The downtrend resumes. And it appears that, the level of support that we might expect to find hovering around $23 a share. Hovering around $23 a share. Of course, if we do bounce from that level, you see here the level of volatility from 27.50 up to 32.50, about $5. I mean, we're talking about, it's almost 20% standard deviation. And then here we even saw a bigger swing, 27.50 all the way above 5. Or sorry, that is 20% there. Pretty tight. So the stock hasn't been super volatile as it has moved through these consolidation channels in these short-lived time frame. I mean, this is about a year of trading activity here before we broke through. So, sometimes when stocks are just continually falling, they are doing so just falling through a floor. That's not what we're really seeing here because we've got this downtrend going on. Technically speaking, this doesn't seem like a bad place. I mean, given the valuation on a multiple basis, we've talked about this. I do believe it's attractive. If you're trying to just absolutely bottom tick this thing into perfection, maybe you might consider waiting a little bit. That's not really my style. I don't care about nailing a bottom. I just care about a decent price at the time. And I think we're there. I think, the behavior of the stock price has been when it hits this lower trend line that it has bounced back. It has bounced back, 10, 20% at a time. Yeah. Okay. So I did do that math right. This is, 15, 20%. This is almost 30%. Not a good looking chart, but not bad either. And I think if you're looking at this stock, you do your own research, you get comfortable with it, and you decide, oh well, okay, I feel comfortable with owning this thing. I think you have to be comfortable with there just continuing to be volatility, as it is with this type of stuff. Anytime you buy something that's just continuing to go down, it can go a lot. It can get depressed a lot further than you think. At the level that it's at now, however, I think it's genuinely attractive. So I definitely, in terms of a grade here, I think I've seen enough to, I wouldn't say I'm particularly bullish on it, but I think I've seen enough to, you know, think that it's interesting and taking a flyer on it. I don't have shares in it today, but yeah, after taking a look at it here, I might consider a very small starter position just to track it a little bit better. Again, I've been watching this company for a long time. I really like their business model. Again, purely due to the scale of their salvage yards and the acquisition costs, the inventory that they have. We kind of discussed how that was attractive for these waste management businesses, you know, that they're, recycling things. When you're in the recycling business and you're getting paid to pick up stuff, you're getting paid to take stuff and then you can sell it. You have a negative acquisition cost. So that unit economics on that type of stuff, very attractive. That's similar to what we're looking at here. So I think that part of their business is durable and a little bit more sticky in a recession. I think it's attractive. I think the valuation is attractive. And there's really no reason in their current results and their guidance in anything to believe that there's going to be an upside catalyst anytime soon. So this is the type of thing that if you're going to buy it, don't expect it to bounce back right away. I will qualify that by saying that the ace in hand for that is that buyback program where they are guiding to, pretty meaningful free cash flow. Again, they're saying 800 million of free cash flow. That's a double digit free cash flow yield. Excuse me, double digit free cash flow yield at the current market cap of 6.3. We see here right here. 12% free cash flow yield. On a yield basis, operating earnings yield 16, 17%. Free cash flow yield. So these are, that's That's enough for me to feel pretty comfortable that there is a good margin of safety on the underlying business. However, in terms of the actual shares, I wouldn't expect it to be anything other than volatile until there's some sort of catalyst. Maybe they do divest out of the specialty business, and maybe they announce that in the next few quarters, and maybe the stock pops on that. I don't know if they will or not, right? But they're certainly giving you every indication that they're going to buy back shares in a quarter where they generate that free cash flow. So again, I think that creates, that's not necessarily an upside catalyst, but it's certainly a floor. And if they start doing that, that could backstop this. That could backstop. There's no guarantee. There's never any guarantees in this business. So I graded a buy cautiously. I graded a buy. I think this is kind of one of those things that, like for me, I would start to dip my toe into, and kind of see how it goes. And then if there's some sort of any crumb or inkling of an upside catalyst, maybe there's some more conviction there. So I graded a buy. I definitely think it's compelling in terms of its valuation on everything except for price book. We kind of debunked that after taking a look at it. And yeah, trying to think what else. I think that's everything for today. Hopefully you found this interesting and useful for your own purposes and entertaining. Please consider liking and subscribing the video, giving me some feedback, commenting below. I try my best to engage with all my viewers. And if you want me to take a look at something, feel free to, give me an idea, give me a submission that I can take a look at. We've had that in the past. And yeah, I enjoy doing this type of stuff, and hopefully you enjoy watching it as much as I enjoy doing it. Thank you for watching this channel, taking a look, listening to what I have to say. And that'll conclude our video today. So I'm going to sign off, but until next time, thank you for watching. All right, bye.